Week number 4, Business 630. This is our course lecture video. This is Professor Hasse, and welcome. Our subject this week is cost of capital and capital budgeting. We'll be reviewing that from chapters 9 and 10. Case number 2, which will be posted this coming week, due on September 26th. It'll be posted on Monday, September 20th. It will be involving putting together a capital budget spreadsheet, very similar to what you'll be doing in your electrics groups case. More on that in a little bit. I'll quickly review case number 1. All the grades have been posted, and also review some key definitions, cost of capital and investment return analysis. And as also, we'll talk about the electrics case, making sure you're all up to speed on what you'll be doing on that, and moving forward and beginning our review and work on that case. So a couple of things. There's been some confusion by some students about due dates and when we are going to be able to, when things are going to be done. So right now you have the electrics case. The electrics case is a group case which you've been put into groups, and we'll be posting that over the next few weeks. Each one of the team members will have some particular duties with that. We'll talk more about that later. That group case is due on our last Sunday of class, last week of class at the end of the week, Sunday, October 17th. It's a case paper, and it's a spreadsheet analysis of the electrics case and the situation of that case. That is due October 17th. This next week, on week number 5, you'll have case number 2, which will be a capital budgeting analysis covering chapters 9, 10, and 11, where you'll be putting a capital budget analysis together. I'm sure all of you, if you've gotten this far in your MBA program and your undergraduate program in business, have already done this before. So this will be practice to get yourself back up to speed for some of us on how to do the capital budget analysis. That is case number 2. That is due on Sunday, September 26th. Then we have week 6, where there'll be case number 3, which will be a topic of financial planning. We'll look at different ways companies can do financial planning. We'll incorporate this into into the company that you selected as a company, which you did in case number 1. And that case, week 6, is due the first Sunday of October, October 3rd, case number 3. Then we have a week off in week number 7, which a lot of you will probably be working on your electrics case. And then we have our final week of class, week 8, where you'll have case number 4, which will be about alternative formats of capital fundraising, more specifically leasing. And we'll talk about that case later down the road, but case number 4, and that also will be due Sunday, October 17th. So you have 2 grades or 2 works to be done, the group case and case number 4, all due on October 17th. So I hope that clarifies some things. In the syllabus or in the course schedule, it says post at the end of the week, and sometimes that gets a little confusing. So I hope that helps you, and I'll put this also in the Blackboard in writing so you all have that information. So let's first of all, let's talk about case number 1. Okay, all the grades have been posted for case number 1, and I thought the class did very well. This is the first time out, and with new professors all the time, and especially in an online environment, it's very difficult to understand what the hell does the professor want? How am I supposed to write this? What does he need? So this is one way of finding out this. And a lot of you asked me questions during the week about what was good, what was wrong, and I appreciate that. One of the things about online learning, if you don't understand, it's up to you to talk to the professor of whether you understand it or not, or what questions you have. So that's hopefully some lessons learned from some of us as the results of this case. Remember, not to sound like a snobby old gangster professor, at this level of MBA study, you are responsible for clarity, for organization, for format, and for presentation. No other excuses at this level of study. If you do not understand the format or the presentation, you need to ask the professor. So I think of all the, if anybody had some trouble with case number one, it was basically in two areas, and that was in the presentation of the format, the APA format, title page, an abstract section explaining the conclusions of the paper or the findings of the paper, the actual paper, and then some citings of some reference or articles of your work. I think everybody did a great job on the risk evaluation and the risk perspectives. Everybody did fine. Some problems on making sure you had all the data that was requested and all the making sure the format was correct. That at this level of academic study, presentation and format is everything. And for many professors, for me, it's about a third of the work. So that's something to just make sure going on in the future. Case number two, which we just talked about, will be a spreadsheet case. You'll do all your work in a spreadsheet format. Okay. Case number three will be another APA format paper. And case number four will be a PowerPoint presentation. You won't have to give the presentation, but you'll be having put together about 10 slides about alternative capital financing and do a PowerPoint presentation file, which I will review. More on that later. So as you can see, different formats for different ways of presenting financial strategy. The case number one, APA format. Case number two will be a spreadsheet format. Case number three, another APA format, but it's going to be in memorandum form, and more on that later. And case number four will be a PowerPoint file. And then the electrics or the case assessment case will be two formats: a paper APA format and a spreadsheet. Clear as mud, huh? Got all that? Hope you wrote some of that down. But we'll go over this over and over again. But again, what I did with every paper, I do not write on any student's papers. At this level, I give you back the paper. I will give you a formatted assessment document, which shows you how I graded it and how I graded your work, and with any comments. This is what that document looked like. You were all received in your grade center this PDF file of a spreadsheet that I do for each one of you on your work. And it looks at a variety of different areas of your study, of your work. And then I grade it excellent, good, satisfactory, and unsatisfactory. And you'll see a X or a check mark in those boxes based on those 1, 2, 3, 4, 5 levels of assessment in the paper. Now, I don't give you the numerical amounts, 94 to 100, 85 to 94, but that's our grading system here at Laverne. And just so you see that. So I assigned you or went through your work and looked at your paper focus, the organization, how you flowed the information through your paper. I looked at the risk evaluation and the risk analysis using the capital asset pricing model, the capital structure percentages. This is where some of us had some areas of grades being reduced. Some of you did not use the information I provided with the actual beta, with the actual risk-free rate, the market return rate. Some of you used your own numbers, and I took off with that a little bit. I wanted to make sure that you gave the information that I gave you, so everything was fairly consistent throughout the paper as far as our class was concerned. The only difference would be the specific beta of the company that you were looking at. So some of us used their own numbers, and you were taken off for that. Another area of concern was some of us didn't give me the capital structure percentages of your company. You gave me the total amounts of debt, the total amounts of assets, and so on, but I needed to see the percentage breakdown of what percent liabilities were of the assets of your company, what percent was the equity portion of your balance sheet as a percentage of your asset base in the company. I needed that information, and you'll see as we go farther along in our course how important that information is. Risk perspective, organizational health, and environmental concerns of risk assessment. Everybody did a pretty fair job on that. Some of us, I needed a little bit more detail. Some of us just gave some very short descriptions, and you were taken off for that. But as overall, that's excellent. To me, that was the most difficult part of the case, is how to come up with an interpretation as a student on a company that was fairly unknown that you were trying to research. And I think everybody did a fine job on that. Abstract support and elaboration was making sure that you stated your abstract at the very beginning of the paper and then proved that abstract, or proved that what you were talking about in your abstract, your conclusions in your work in the paper. So I was looking for some consistency in explaining your abstract, explaining what the paper is about, and then following up in the work throughout the case. And then finally, the presentation format, the APA format of title page. I'm not that big of a stickler, but I took 1 or 2 points off if you didn't have any information on the title page, like your class number, your class, Business 630 Corporate Finance, the date of your work, your professor in the class. That was kind of important stuff. I took maybe 1 or 2 points off if you didn't have some clarity in what this was all about, this paper. Also, if you didn't have cite any references, or your references were rather vague and general, I took a little points off for that. But you'll see in the course of that review that I give back to you, I put an X in the appropriate columns, and I totaled up the related points and determined your overall grade of your paper. If I had any specific comments about the nature of your work, I put them down here. So again, if as all you download that and read it, let me know if you have any questions or concerns. But I think that assessment gives you a pretty good perspective of what is going on. And I will do this for each one of our cases throughout our course, give you this assessment worksheet where you can see how that grade was determined. This followed along a little bit of the rubric that I provided, and there'll be a rubric for every case that I give you about what I'll be looking for as far as the grading is concerned. So that's how I graded case number 1. And all in all, everybody did a very fine job. But remember, this is only the first of 4 cases, and really the first of 5 assessments in our class, 4 cases and 1 group case. So you have plenty of time. I think we all did a great start. And again, understanding this is a professor with many of you didn't have before, and a little bit of confusion, but it's up to you to ask me questions and make sure you understand how to put together this material. Okay, good job. Okay, here's our Blackboard site. I want to go over a couple of things on this Blackboard site. Get up to date and make sure you are aware of it and have looked at it. Yeah, first of all, in the case study format now, case study file folder, you'll now see the electrics case with the various files that you are to review. I ask you this week to pretty well maybe spend this weekend in reviewing these files, looking over the material. Here's our groups. I haven't heard back from anybody about any disappointment with the groups I've selected. Make sure you made a good idea to contact your fellow teammates, put together and make sure you're communicating, and again, begin the discussions of who does what in your group. Who does the market review, who does the capital budget analysis, who does the risk analysis. And I'll talk about that in just a minute, those 3 sections, and the appropriate questions that are associated with this. Remember, this case requires 2 files to be presented by your team, by your group, a file in Word or PDF format on a paper, the paper to be anywhere from 5 to 10 pages, and then a spreadsheet or capital budget analysis work, which is what you could say maybe the exhibits, the addendum of the written paper, which shows the information that you calculated to come up with your interpretations of the case. So again, this next coming week, in week 5, we will put a section of our course lecture that week on the key bullet points of what you have to find out in this case and what you have to run through in order to complete the case, and also talk about some of the material of the case and what I'd be looking for and the rubric. So we'll look at that in week 5. But I think for this week, maybe send a message to all your teammates, make sure you're all on the same, you're all communicating and understand what's going on, set up your team, and then again, begin and download the material and begin to take a look at it. I've given you PDF and Word doc files for the main assessment case and the rubric. And then I've given you a sample case paper from some other work from before that you might be able to, which you can download and just see the format of an APA case format for this assessment case. That might give you some good ideas of what we'll be looking at here. Okay, so again, make sure you this. Now again, as I mentioned in my introduction video earlier this week, make sure you all are carrying your own weight as a team member and a group member in this case. This is important. And if anybody's not doing it, not communicating, not answering emails, not answering text messages, whatever, I need to know that. It's not a question of telling on a teammate and being, for lack of a better word, tattletale. It's being professional. If you're not doing your job, your professor needs to know about it. And I will talk to you about that, and stay respectful and stay professional. But we all are in this together, and we all want to get a good grade. And the only way to get a good grade on this assessment case is you all have to work together. So just make sure of that. And if there's issues, problems, time management issues, you need to let me know. Okay, that's important. Okay, so that's the electric case. And let's take a look at what this electric case, just briefly, what you'll be reading and what I need you to maybe concentrate on in your review of this case before we get into specifics in week number 5. Okay, the electrics case is fairly similar to any of you who have taken your undergraduate or maybe 500D in the old MBAX program, other prior finance courses at the University of Laverne in the business administration program. You might have had California Best Trucks case, Road Kings case. You might have had other cases that are fairly similar to the electrics case. And then basically what it is, it's a company that wants to change their strategic planning of their business, go into a new product area. And your job as a reviewer, and I guess you could say you're a consultant to this electric company, is to advise them on A, is the market and is this a good time to do this change in strategy? And what's the change in strategy? It's to develop an electric engine kit to convert vehicles to electric. So the company has come up with a kit, an engine and a converter or controller to convert an electric, or to convert a vehicle into an electric car or electric bus or electric truck, whatever. And that's what this company wants to sell. And there's 2 types of kits. Your job is to do a capital budget return on investment analysis of the cost, the revenue of these kits, and compare the 2. And would you recommend any one of these kits as a vehicle to generate new return for the electrics company? And to prove this, you have to answer a series of questions. And these are the questions I'm referring to in the case, these 9 questions. These are the questions that you as a team or a group will split up and answer. Now, naturally, some questions have to be answered before other questions could be answered. It's most specifically the risk analysis. You need the capital budget analysis done in order for the risk analysis to be done. So that's where it requires teamwork and communications amongst your team. So I would like you to read this case over in this weekend or prior to week number 5 or into week number 5. So you have a general idea of what this is all about and what you have to put together. You have to do a market review. Look at question number 1 on page 4 of this case analysis. How much importance should be given to the energy cost situation? Okay, not only is your team putting together data as far as return on investment, but also you need to do some type of market review. Is this a viable option that this company should do at this present time? Is there a market to do this? What does the energy situation, and this company is located in Southern California, What does that have to do? So a little bit of a market review. That's one of your teammates' responsibilities to do that market review. Is this a viable? Remember, strategic management and critical thinking for companies is not only crunching the numbers, it's looking at the markets, looking at competitors, looking at the current state of the economy. Has a lot to do with the decision-making process just as much as are we're going to make a good profit. So that's part of this case. And then once that market review is completed, and you can do that at the same time that you're doing the capital budget analysis, then you go ahead and determine the cost of money, determine the cash flow, and we're going to take a look at that beginning with our ending part of our lecture today. And we'll talk more about that also in week number 5. So please take some time to review this. Maybe as team members decide which team members is going to begin this, do what questions in your group. And if you don't decide this week, that's okay, but have some pretty good idea by the end of next week. So take a look at the electric case. Here is the rubric for the case, which gives you an idea how I will be grading it based on forecasting cash flows, determining the cost of capital, or better known as the hurdle rate, determining the net present value, the internal rate of return, the profitability index, and for the company based on your average scenario analysis, preparing a risk analysis of sensitivity based on the following percentage deltas for net present value, and how you explain your decision and your overall presentation of the paper. Some of you are thinking, God, what the hell is he talking about? Well, we'll talk all about this every week for the next 3 weeks in this course to help you get through this and also help you understand what I'm looking for. So there's the rubric for this case. All right. So rubric, the sample paper, and the case analysis itself, please make sure you read that and make sure your teammates are doing it all at the same time. Don't have one teammate do this early in the week and then everybody else wait to the weekend. Make sure you coordinate your schedules if you can, and you're all on the same page and have all the data all at once together and discuss things. That makes it go a lot easier and a lot quicker. Trust me on that one. Okay, back to the front page of our Blackboard. You also have a file folder now underneath the case study called Electrics Case Project Groups. Now I am on the student preview mode of my Blackboard. So if I click on that, you won't see anything. But in your individual Blackboards, you should see your group listed here, which you can click on and email and communicate with and send files to your specific group mates. If any of you do not see that or do not have that, please be sure to let me know. All right. And so that's where you can communicate and do your work. You'll have to designate one team member to do all the posting once you're all done of posting all your 2 files to this group assessment case file folder once you're all done, but more on that later. Now, also, if you go to week number 4 of our class, you'll now see a file folder called Lecture Class Review. And there's a spreadsheet, which I will be going over now, which is going to be of much, much help to you all and your teams in doing this electrics case and in also doing case number 2, which I'll be posting of Monday next week, week number 5. It's a capital budget return analysis. It's reviewing that process and making sure we're all on the same page of how to do that. Here's a spreadsheet that I'd like you to download and review, and also I'll be reposting this after I do some adjustments to this after the lecture. But this is a very important spreadsheet to help you with the electrics case and with your case number 2 next week. It defines all the key points of chapters 9, 10, and also 11, which we'll look at next week. Okay, here is this spreadsheet from week number 4 of our class file folder. It's broken down into 5 tabs. Cost of capital, which is a definition of the cost of capital, capital budgeting, weighted average cost of capital of a specific calculation for a base analysis, and then the risk analysis, which is a sensitivity and a scenario analysis of the original base case. We'll do risk analysis next week in week number 5. But I wanted to walk through this and make sure you understand it. Some of this might be fairly new, or it's been a while since you've seen it, but this is the key indicators or the key information you need to make strategic decisions involving the investment in a product, an investment in a market, to determine whether that's going to give you a return on investment. Okay. Well, what is the cost of capital? Well, the cost of capital is what it costs you to get the money that you're investing in an asset. Okay. And that's, remember, there's 3 sources of capital legally for a corporation and a business. 1, debt, the issuance of debt, either short-term debt, which is non-interest bearing, accounts payable, or long-term debt, which is interest-bearing and which is usually associated with the investment of fixed assets. You need long-term debt because those fixed assets need time to generate revenue, cash flow, profits, so you can pay off that long-term debt. Accounts payable, short-term debt, is mainly for working capital, day-to-day management of your company, and is not used in the purchase of fixed assets. So working capital is not part of the cost of debt associated with this analysis. Also, the second way of obtaining capital besides debt is the issuance of equity, the issuance of stock. All right. That's the cost of equity associated with the capital asset pricing model. Another, or the third form of capital, is the making of a profit, profits, in which profits are owned by the shareholders of the company. That's part of their equity position. And naturally, the cost of using profits would be what you're not giving as a return on investment to your shareholders. Instead of giving them a share or a return of the profits, you're using those profits, investing back in the company. So debt, interest-bearing debt, equity, stock, and profits. Those are those make up the capital structure of a company. The capital structure is the relationship of debt, equity to the assets of the company. So for example, here's an example here where a company has 44% debt, 56% equity. All right, that's the capital structure of the company. Now they're thinking about going out and getting some capital to invest in an asset. So what is this company's cost of capital? All right. What is their weighted average cost of capital? The cost of capital is what it costs them to borrow the money after taxes. The cost of equity is what they are required as a return on their investments or by their investors in relationship to the risk and returns of the market. That's the capital asset pricing model. And that capital structure is used to determine the weighted average of the cost of debt and equity in relationship to what part of the business is funded by those types of financing. And that's how we get the WACC. So in this example here, we have the interest rate on some debt of a company or on their long-term portion of their debt is 10%. The company's tax rate is 40%. What is their after-tax cost of debt? Well, it's the 10% times 1 minus their tax rate. That's the after. So it's costing them 10% to borrow the money. But remember, companies get to deduct interest as a tax deduction as an operating expense on their businesses. So they can deduct that tax on their interest. That if they're whatever their tax rate will drive what their after-tax cost rate is. If I take 10% times 1 minus 40% equals 0.0 or 0.1, 10% times 1 minus the tax rate. So 1 minus the tax rate is 1 minus 0.4 or 0.6, we get 6% after tax cost of debt. What that means is, yeah, they're still paying their investors 10% interest, but when they put that interest expense on their tax return, they get to deduct that on their taxes. So they can deduct up to 40%. That's their tax rate. So their true after-tax cost of debt, taking into account their tax situation, it's really costing them 6% on their money. That's the cost of debt. The cost of equity you did with your company last week in case number 1. I gave you, you had a company. I asked you to find their beta. I gave you some specific interest rates to determine their cost of equity, and you did that. And all of you did a very good job on that. Notice in this company, the risk-free rate with a beta of 0 is, in this example, 1.75. The market return is 8.5%. That has an average risk in the market of 1. This company's specific beta, who's going out and getting the money, is 1.5, fairly risky company. So what is the cost of equity? It's the risk-free rate plus the market premium, which is the market premium is defined as the market return minus the risk-free rate times the beta of the company. And here I did the calculation. Risk-free rate 1.75 plus the market premium, which is the market return 8.5 minus the risk-free rate 1.75 times 1.5. And you get 11.88%. So here, by taking the current figures as of today for this organization, this corporation, their current cost of debt based on their current credit situation in the market, their current tax rate, it's costing them 6% to borrow money. That doesn't mean it's going to cost them 6% in the future. Just as a snapshot on this day when they're doing this analysis, it's costing them 6% to borrow money long term. What do the investors demand as a required rate of return based on this company's risk in the market, 1.5, compared to the risk of 0 risk and market risk? It's costing them almost 12% for their cost of capital for equity to make sure the investors will be happy if they decide to and give them stock to finance this asset. So now we take those numbers and we apply them to the capital structure of the company. If the average after-tax cost of debt is 6% and 44% of the company is in liabilities, that weighted is 2.64%. If we have 56% equity in the company and our cost of equity is 11.88%, that weighted is 6.65%. Thus, the weighted average cost of capital is adding the two together. This company right now, today, is taking 9.29% to cost of money. And that's called a lot of different names: WACC, cost of capital, hurdle rate, opportunity cost, the cost of cash. All different ways of explaining what that 9.29% represents. So now let's apply this thinking of determining cost of capital to an actual case. Here we have a company under the capital budgeting tab is going to go through the capital budgeting process. You're going to be doing this and gathering this information in case number 2 next week and in your capital budget process. You're going to determine what is the investment in the assets. How much are you investing? What is the depreciable life of that asset? Because that's going to determine the financial life of this asset. What is the net income that's going to be generated into the future of this asset? What is the net cash flow, taking the net income and taking into account depreciation, working capital, salvage value, to determine the net cash flow of this asset? Once that is all determined, you can determine a return analysis, taking your cost of capital, your net cash flow, and determining your net present value, your internal rate of return, profitability index, and even payback in years. And once that's complete, you do a risk analysis. Is that information that you have based on projections, cost of money, cash flow? Let's test that based on scenario and sensitivity analysis. That's in chapter 11. But we're going to look at an example of this, and you're going to be doing this example next week. First of all, Here's a company that has a debt to assets relationship of 60%. It has a tax rate of 30%. It has an interest rate on their debt of 9%. It has a risk-free rate of 1.75%. It has a market rate of return of 9%, and it has a beta of 1.25. What is this company's cost of capital? Take a moment to look at that. Okay. What is our after-tax cost of debt? Well, that equals our interest on our money, 0.09, times times 1 minus our tax rate. If our tax rate is 30%, 1 minus our tax rate is 0.7. Our after tax is 6.3%. So we're paying 9% on our money. We get a tax deduction of 30% of that as a tax rate. So our after tax cost of debt is 6.3. Let's put that 6.3 down here and weight it by our cost of debt, our weighted average, or our cost of what share of debt is to assets. It's 60%. Thus, our weighted average after-tax cost of debt is 3.78. Let's do our capital asset pricing model. We have a risk-free rate of 0.0175. We're going to add, let me put these in parentheses here, or it won't work. 0.0175. And we're going to add to that our market risk premium, which is our market rate of return, 0.09, minus our risk-free rate, 0.0175. And we're going to multiply that times our beta of the company. I think I did that right. Maybe I didn't, but let's find out. We did do it right. Amazing for an early morning. So in other words, our cost of equity is the 1.75 risk-free rate plus the 0.09, our market risk premium, which is 9% minus 1.75, times the beta, 1.25, and we get 10.81%. That's our cost of equity. Put that down and weight it by 40%. Our cost of equity, or our capital budget share of our capital structure, is 40%. How did I get that? Well, if our debt to assets is 60%, our equity's got to be 40. It has to total 100%. So 40 has got to be the weighted average of equity. I weight that. Our weighted average cost of equity is 4.32, and that equals 8.1%. So we just did another example of the cost of capital calculation, taking into account debt and equity. These are two different expectations in the market today of what it's costing this company to borrow money and to issue stock. The borrowed money is taking into account their current debt position and their current interest rate on that debt, less the after tax. And their equity is determined by the current market rates of zero risk, average risk, and the specific risk of the company. 8.1%. So now we take that 8.1% and we now include it in a capital budget analysis. Now I've gone ahead and set this up pretty much, and you can look at it. But now we have it, their WACC as being 8.1%. So I'll put that there. Maybe I'll bold that so you know where it came from. And now here's the capital budget analysis. And I'm sure you've seen this before. This is your text reference is page 412 to 430 in your chapter 10, but it's taking an investment of $1 million today, projected out over its depreciable life of 10 years, determining its selling, how many units they plan on selling every year at a $20 per unit selling price. That's what they anticipate generating as revenue off this, and that revenue is increasing at an inflation rate of 2.5% per year, which is pretty much close to what the market is today. They have a variable cost of $8 a unit to produce and manage this product, inflating at 2% a year. And their fixed costs are $50,000 per year, inflating at 1% a year. Their depreciation is straight line, 10-year depreciable life, $1 million investment, that's $100,000 a year. That determines their operating profits off this as of roughly about $1.9 million. Their tax rate is 30%. They take tax out of that. Here's the net income, net accounting income they anticipate generating off this investment, roughly about $1.3 million. Net accounting income is a lot different than net project cash flow, because now we have to take into account, as I said in this little example here, net cash flow is also taking into account depreciation, working capital, and salvage value of this project. So notice here, this project has an investment of $1 million, fully depreciated over 10 years, but with a salvage value of $50,000 in year 10. There it is right there. In other words, at the end of 10 years and it's fully depreciated, they determined that they're going to be estimating to get $50,000 of scrap or salvage off this asset of $1 million. Because they fully depreciated the asset, means that that $50,000 is taxable gain. So you take 30% out of that $50,000, and they're getting a net after-tax salvage value in year 10 of $35,000. You add back into depreciation, that $100,000 is added back in as cash flow. Why? Because depreciation is a non-cash expense. And so thus no cash has been distributed here. So you add it back in as cash flow. And finally, the working capital. Working capital is working capital, inventory, receivables, and current liabilities, accounts payable, accruals. That working capital required to maintain this $1 million investment over the course of the life of the asset. And this working capital is determined by a rate as a percent of revenue. The revenue is the base. So working capital is 12% of revenue for the previous year. So in order to get this project off the ground, in year 0, I'm going to have an additional investment of $60,000 to have as working capital as a cash outlay, which is determined by taking 12% of the first year's sale. And then working capital is increasing a little bit every year due to the revenue base increasing by inflation every year. So notice how I calculate working capital in year 1. I take the delta between year 2 and year 1 revenue, which is $12,500, and take 12% of that. Here's the formula here. Year 2 minus year 1 times 12%. So an additional $1,500 of working capital is going to be outlaid in year 1 to maintain this investment. So at the end of year 1, I now have $61,500 of accumulated working capital. Remember, working capital is assets and liabilities. So it increases or decreases as a whole every year. And as revenue continues to grow due to inflation, thus my working capital outlays increase. But notice what happens in the final year at the end of the life of this asset. I take 12% of the entire year 10 revenue, which is $74,932, and is now in the final year added back in as positive cash flow. Why? Because the project is over and there's no longer a need for working capital expenditures. If you take from year 0 to year 9 and add it up, that's $74,932. So the net amount to the cash flow of this project is 0. It nets out over the disposable life of the asset. But you're properly showing the expenditures and requirements of cash throughout each year. Thus, we get our disposable net cash flow of roughly about $2.4 million on an investment of $1,060,000. Hope this is all beginning to come back to you. So, and $1 million investment is going to generate net cash over 10 years, its depreciable life of $2.4 million. Is this a good investment or not? That's when we have the 4 different methods of determining return investment. Net present value, return in dollars. Internal rate of return, return in a percentage. Profitability index, return in a ratio. Payback, return in years, time. And now our job is to determine those. First of all, to determine a net present value, we have to determine the discounted cash flow of year 1 through year 10 of what this $2.4 million is equal to today. And that's why we determined our cost of capital. That's our discount rate, 8.1%. So now I go to my formulas, function, financial, and I look for the function NPV, net present value. Our cost of capital is 8.1%. Our values are year 1 through year 10. In other words, we're going to be now taking years 1 through year 10, that $2.4 million that's totaled, and discount it back at 8.1%. And we get $1,564,799. That's our discounted cash flow. Our net present value is the difference between that discounted cash flow and the investment in year 0, which is the investment in the asset of $1 million and the working capital requirement, $60,000, $1,060,000. Thus, our net present value is $504,799. Pretty good. Our internal rate of return is, what is this amount in a percent? Formula, function, financial, internal rate of return. All we have to do here is put in the values, starting with year 0 and going to year 10. Just putting in the values, and the algorithm is going to calculate our interest on an annual basis. 17.03%. So we're generating $504,799 of profit in today's dollars on the investment at a rate of return of 17.3%. That's compared to our investment cost of 8.1%. Sounds pretty good. That's our return in a percent. Our profitability index is, what is this return in a ratio? And that ratio is taking the discounted cash flow and comparing it to the investment as a ratio, $1,564,799 as a ratio to $1,060,000. That's a ratio of 1.48. That's a ratio. And our payback in years, which you do not have to calculate this in your electrics case, but you will have to calculate this in case number 2, is how long did it take us to return in straight dollars the $1,060,000 investment? 1, 2, 3, 4.94 years. It took us almost 5 years to pay back the $1,060,000. And to calculate that, I just take my $1,060,000 and add back in every year of cash flow. Until I get down to year 4, I still have $211,987 of the investment to pay back. In year 5, I have $226,717 of cash flow. So I know I'm paying it back somewhere between year 4 and the end of year 5. What year? I just take 211,987 and divide it by 226,717, and that's 0.94. So 0.94 of year 5 till I pay it back. 1, 2, 3, 4.94 years. This is what chapter 9 and 10 is all about. Determining the net project cash flow and determining the return analysis in dollars, percent, ratio, and time. 4 figures to determine the same return, just looking at it in dollars, a percentage, a ratio, and time. But to do all this, you have to determine your cost of capital. You have to determine what are the inputs of the key factors and apply those key factors in a cash flow analysis. You'll be doing this process without all the numbers. You'll be filling in the numbers in an example and a case I give you next week in case number 2. And my lecture video of week 5 will be posted on Monday to talk all about that. Okay. The final part of this file, which I'll save and repost to week 4, is this tab here called Risk Analysis. And this is the subject of next week, week 5, chapter 11's analysis, is how do we determine whether the numbers that we're using in this base case is decent? Is 25,000 units selling every year a number we can work with? Is these various components of selling price, variable cost, fixed cost, WACC, are they all legitimate? Do they provide us with an adequate appraisal of profitability for this $1 million investment? That's what the risk analysis does. And the risk analysis is on pages 465 and 469 of your textbook, and we will discuss that next week. Many of you have seen this process before, where you calculate the cost of capital. You do the base analysis to determine the returns in these various components. Please refresh yourself with this, and we'll be in good shape. And we'll talk about this more next week in week 5, and you'll practice this in a case due a week, September 26th, Sunday the 26th. And we'll talk about that in our Monday video. Also, I'll have a little sneak peek of that in my introduction video on Sunday the 19th. All right, everybody, that's my lecture for this week. All right, please refer to case or week number 4 in your Blackboard and review this material. Also, at the same time, please make sure that you talk with your team, download the files for the electrics case, get to know that information, and begin to start getting your team organized for the coming few weeks. Any questions or concerns, you know where to find me. I'll see you in a couple of days in our week number 5 material. No graded work due this Sunday. Your next graded work is due September 26th. Thanks, everybody. Have a great weekend, and we'll talk to you soon. Adios.